Good morning, everyone, and a very warm welcome to our webinar today, Moving Forward with EFRAG Simplified ESRS. My name is Lynn, and I'm the Marketing and Communications Lead here at Nordic Sustainability, and I'll be opening the session today. While we wait for everyone to settle in a little bit and get their cup of coffee and get a comfy seat, feel free to drop in the chat where you're tuning in from and which organization that you're joining from. It's always so lovely to see who's in the room. It brings a little bit of connection and makes us feel like this is less of a quiet digital abyss and more of a community of people trying to figure things out together, learn across sectors and countries. I can already see in the chat that there are some familiar names popping up. So I'm very happy to welcome you back. And for the new ones who have never been to one of our Nordic Sustainability webinars before, welcome. Before we unfold into this wonderful sustainability odyssey, I have two housekeeping notes to share with you. The first one is that this session is going to be recorded, so you're able to find the recording along with an article summarizing all of the key takeaways on our website at nordicsustainability.com. So no need to take any furious notes and screenshot every slide. We have you covered. You'll be able to replay everything at your own convenience later on. And on the second note, we have now opened the Q&A section, so feel free to submit all of your burning questions and curiosities about ESRS into the Q&A section that is at the bottom of your Zoom window. And this will help our speakers filter through all of the questions and make sure to answer as many questions as possible. Whether you join because you're already deep into the ESRS universe or because you're hoping to finally get some clarity on this evolving landscape, we're very happy to have you here today. And now, without further ado, I'm going to pass it on to Anniina.
Thank you so much, Lynn, and good morning, everyone who is tuning into our webinar here this morning. It's certainly an exciting morning to wake up to. We also have some fresh negotiation results from the Omnibus trialogues. So we'll do our best to both uncover some of those things here today, as well as, of course, dive deeper into the revised ESRS. My name is Anniina Kristinsson. I'm a managing partner here at Nordic Sustainability. I'm joined by my colleague Julia, and of course, our two expert commentators, Merete from Ørsted and Camilla from Nykredit. We're so happy to have you here joining us, commenting on these new developments. Very exciting to have you here, and welcome to all three of you. Let's get started. We have a lot to unpack here today. So if we just go over to the next slide, we can see, first of all, I'm going to take you through some of the updates on the Omnibus status. Then Julia will do a more technical walkthrough of the key changes to the ESRS. And then we'll do a joint reflection on the changes where Merete will give some insights on what this will mean for a large multinational company like Ørsted in terms of their reporting and what changes might be on its way because of these revised ESRSs. And of course, Camilla, you're here to comment a bit from a bank's point of view. What's the data you're most interested in, and what are the changes that you are really keen to see here as we move into 2026? We're also going to take some questions from the audience here today. You are quite many online. I believe we had close to 300 sign-ups to this webinar. So we're thrilled you've chosen us this morning to spend time with. Please ask the questions in the Q&A section, and I'll do my best to pick out some questions when we get to that part. So let's dive in. First of all, Nordic Sustainability, those of you who are familiar with us or might even have worked with us know that we're a Copenhagen-based sustainability consultancy. We work with companies all over the world, but of course, the majority of our clients are European, and many of them are also from the Nordic region. We work across multiple different sectors, and we advise clients both on strategy within sustainability, reporting and policy, climate, nature, circularity, and of course also investment and ownership is part of the rising agenda when it comes to sustainable investments. And we work across all ESG themes and are also working with different parts of the clients we work with, both in terms of their strategic departments or procurement departments, product design, and so on, to really provide holistic ESG services. You'll see that we'll try and weave in also some of our experiences from working with these companies as we walk through also the standards. And of course, you're always welcome to reach out if you would like to discuss more. Now, let's dig into the fresh news of today. Those of you who are monitoring what's happening with the Omnibus, you can for sure expect a day where LinkedIn will be exploding with analysis about what these results mean, and some of those first ones are already in. But of course, last night we got the news that there is a result in the Omnibus negotiations. I almost feel like I'm commenting on a sports event, and it certainly feels like that because those of us who have been following this for the past year, it's been quite the ride and no lack of drama and political twists and turns. Let's dig into what this really means. So, first of all, it's been a full year of a lot of different steps, and it's almost exactly a year ago that it was announced that this omnibus process indeed would be kickstarted, and that it was with simplification and competitiveness in mind that some of these changes to the CSRD and the CSRD were planned. Throughout 2025, we've seen different positions emerge, both from the council and then the parliament. We've also seen quite a lot of political back and forth on this, not to say the least in the parliament, in the European Parliament, where there's been a lot of different positions, both regards to the CSRD and the CSRD as well. Today, we're not going to focus that much on the CSRD. We have a lot of content on that legislation as well on our website, and we'll certainly be posting about that more as well as we start to familiarize ourselves more with the results here. But today, we're really in this webinar focusing on the CSRD. I think worthwhile noting is that there's been two parallel processes happening here in 2025, and this is also what this slide illustrates. In the gray section here, you can see the timeline that has had to do with the omnibus negotiations. And of course, now we have some results from those negotiations, and we're still expected for the trialogue discussions to be fully finalized. Now we, of course, also then await some of the more formal confirmations of those positions, and to our understanding, there will be a vote in the European Parliament still before Christmas to confirm also these negotiation results. In parallel, there's also, of course, been the process of simplifying the ESRS itself, and this is a task that EFRAG has handled. EFRAG has been working on the simplification throughout the year. There's been a large public consultation. There's now been also some drafts already floating around since summer, and now just earlier here in December, we saw the updated drafts, the exposure drafts. What will happen now is that once the trialogue negotiations are fully completed and the negotiation results have been confirmed, the European Commission will kickstart the process to turn those exposure drafts into delegated acts, which will happen roughly within 6 months from where we're sitting right now. And it's only after that the ESRSs in these amendment forms enter into force. There will be some hearing for different EU institutions and also a smaller public consultation still ahead of us. But more or less what we see here today in terms of the revised ESRSs are what we assume will also be finalized then. But of course, this year has not been without its surprises. So let's see if there are any more surprises in store for us as we turn the page into 2026. But I think I can dare to say that more now than ever, we are starting to see what the outlines of this new reporting landscape truly looks like, who's affected, and what the content is. Let's go on to the next slide here. So hot off the press here, and I dare say that we hoped that we would have something for this webinar, but we were also very happy to see that there actually was some conclusion out of the talks yesterday. And it seems, based on what we've seen this morning, that the political agreement now, of course, it encompasses both the CSRD and the CSRD, but again, I'm going to focus here on the CSRD. It sets now the reporting scope for companies that have more than 1,000 employees and a net annual turnover of 450 million euros. similar threshold for the 450 million for non-EU companies as well. There are also some exemptions and also some transition periods for those companies who were in the wave one but are now falling out of scope. And interestingly, also, we of course see that there is a limitation now for companies that are smaller than 1,000 employees, where they do not have to report information beyond the voluntary ESRS and can also refuse to report information that goes beyond that. This is a result that, of course, in many ways is not that surprising. It's quite well in line with the Commission's and the Council's positions. And it seems that also a lot of the compromising has happened on the CSRD's side when it came to the Parliament's positions, and that there were some hard-fought political wins from the Parliament's side. There would be my initial analysis here, without having fully read all of the content yet, because it's so new, but it seems like that's partly what's happening here in terms of the Omnibus results. Let's look a little bit more into what EFRAG really set out to do then in relation to simplifying the ESRSs, which is really the main focus of our webinar here today. So, of course, the task that EFRAG was given was to simplify the ESRSs further, with really competitiveness and reducing unnecessary burden in mind. And some of the simplifications that we also will walk you through today, we can say EFRAG has been successful in simplifying the ESRSs. We do believe that this will also enhance readability quite a bit in terms of the reporting. But of course, there are also things that are probably lost now along the way as things have been cut. And we could, of course, debate more about has the right things been cut. Nevertheless, EFRAG estimates that approximately 61% are now reduced on the data point side. And of course, that's quite a significant reduction to what we saw previously. Next slide, please. What will happen now, as I already mentioned, is that there will be a process to turn these revised standards into a delegated act. And after that, of course, EFRAG will still play a role in terms of the implementation of the ESRS. And they've communicated also that they stand ready to support. There will be more explanations and Q&As coming out. And maybe more importantly, for those who might have missed it, they've also launched a ESRS knowledge hub as a tool to navigate the ESRS ecosystem. So make sure to familiarize yourself with all of those guidances that are also coming out from EFRAG at the back end of the standards now having been revised. Next slide, please. Here's where I hand over to my good colleague, Julia, who will do a technical walkthrough of the key changes to the revised standards. Go ahead, Julia.
Thank you so much, Anniina. Yeah, so let's just jump straight into it. And maybe we just quickly start with the big picture. As Anniina already mentioned, the EFRAG and the European Commission, to simplify it, have introduced a set of simplification measures that not only focus on the structure, but also the expectations of your ESRS reporting going forward. They have a stronger emphasis on the usefulness of information and fair presentation. This means that companies should focus less on compliance box ticking and more on providing information that genuinely helps the users understand sustainability performance. And this is quite clear in the language that they're now using in the ESRS, is that they're really focusing on who's the audience and who needs this data from your reporting. The standards have also been significantly shortened and clarified, and not only in a data point perspective, but also just in the general text and information received. They're also more principle-based, which of course gives companies quite a lot of flexibility in how they present your policies, actions, and targets, while still ensuring some consistency. But this is an area we can debate quite a lot, whether this has been fully successful. And then finally, there are also substantial reliefs, and there is this proportionality mechanism. This includes ad hoc phasing in for difficult disclosures, as well as enhanced interoperability with ISSB, but we'll get into that in more detail. There is also this horizontal burden reduction relief to try to make sure that, again, it's the usefulness of information that takes priority. But if we go to the next slide, then we can actually see what this actually means. The narrative part of the standards, if we kind of look at what does this then mean as a whole, especially around your policies, actions, and targets, which is a large focus for a lot of companies, they're far more principle-based. You get quite a lot of flexibility in how you wish to present your information now, but there are also, I think they're trying to give clear expectations for what good looks like. From my point of view, this is also where one of the biggest risks lie of the simplifications. The simplifications have very clearly removed a lot of the rigidity that previously supported comparability across companies. The new ESRS state that activities can be excluded from metric calculations if they are determined to not be a significant driver of the IROs relevant to that metric. And now also with proportionality estimates, company-specific scoping, and flexible disclosure formats, two companies reporting on the same metric might not actually be reporting on the same thing at all. So really here we see the burden shifting from comparability will now depend on how transparently companies document their exclusions, how they write their boundary decisions, and how transparent they are with their calculation methods. And without high quality accounting policies for this sustainability information, users will find it very difficult to actually interpret the numbers that are presented. So this is very key that companies keep this in mind. And of course, we'll see a difference in transparency around these areas. But it's also important to keep in mind as a user of these reports, what is actually behind the numbers, what are the exclusions that have been included. I think what we see if we go to the positive side of it as well, the standards are shorter. They're easier to navigate. There are clarifications on core concepts. The DMA has been explained in better detail in more clear way. For example, they define what constitutes an actual impact versus a potential impact. They say what's a positive impact, what's a negative impact. They remove a lot of the ambiguity that was in the original standards, so there's less room for interpretation when it comes to the DMA. Also, just important to mention, there has been interoperability with the ISSBs, and this has been improved quite significantly. But a little caveat and something important to keep in mind is that some of the ESRS reliefs go beyond what the ISSB allows. So companies aiming for dual compliance need to pay attention where these two, especially related to the phase-ins, diverge. If we go to the next slide, we can maybe unpack some of the standards a bit more in detail. Just to mention some of the highlights that we've noticed. And I think we see it very clearly in the environmental standards as well. In E1, a lot of the metrics have been streamlined. For those who are very deep into it, you'll probably notice that energy intensity under energy consumption has been removed, or that the GHG organizational boundaries have been revised to align far stronger with the GHG protocol as well. There are some voluntary data points that have become mandatory. For example, in E3, on-war withdrawals and discharges are now mandatory if it's material. E4 has taken a large hit, in my opinion. A lot of the data points have been consolidated, simplified, and of course, since such a big part of E4 was voluntary, we have seen a significant reduction here. But there is a bit of more clarity on reporting on sites that are affecting biodiversity sensitive areas. So I feel like when reading the standards, we get good things and we get things that could, of course, still have remained improvable. I think it's very important to note the phase-ins in general are still the same as the previous ESRS, but have been extended in a lot of cases. For example, E4 has a new phase-in for Wave 1 companies until financial year 27, and this also includes S2, S3, and S4. In E5, there are completely new metrics on critical raw materials and waste of unknown final destinations, and these have been added. On the social side, many policies have been simplified with a significant reduction in S1 workforce metrics and far clearer disclosure requirements around engagement channels to raise concern and remediation of the impacts that occur on your workers. I think a lot of people will be happy to know that governance has been restructured completely to better align with the other topics. A lot of the very granular data points have been removed, and it has been consolidated stronger with ESRS 2. And what does this then mean in practice? One thing is, what does it mean on paper? What are the actual changes? What does this mean for you as a company going forward? First, the materiality assessment has become far easier to run and document. It has a far more streamlined approach, and that has been allowed. So, for example, where possible, you can remove the assessment of each criteria of severity on clearly material topics. And you also get a far easier guidance on how to treat prevention. How do you treat mitigation? How do you treat remediation within your assessment? So we're going to see that it's going to be far easier to create these business aligned double materiality assessments that allow you to focus on where the actual impacts are coming from. Second, companies can spend less time on justifying why topics are not material and more time really improving the depth and quality of the disclosures that will then come out as material. And I think this is very clear in how they're writing the standards, what they're trying to communicate. Thirdly, there's of course the preference for direct value chain data has been removed. Again, this is a contentious point because then how can you ensure accuracy in what you're reporting? But now companies can use estimates when appropriate, of course, as long as they consider the how good it is in practice and how reliable the assumptions or estimates that they're making. You're also not ever expected to collect value chain data outside of what the EU law allows. And of course, this limits the trickle-down effects, as Anniina mentioned, to the smaller companies. And finally, we're seeing that all these things will probably lead to that sustainability teams will see a reduction in a lot of the internal burdens. A lot of the processes are simplified. A lot of the assessments needed are simplified. There are fewer data points, fewer data owners that will probably be needed, and fewer iterations. We expect that this will free up capacity across the organizations to actually work on the assessments that matter more, whether these will be your CTPs, your LCAs, your biodiversity assessments. The ESRS still strongly recommends using LEAP assessments, for example, and really focusing on driving ESG just beyond reporting. And I think if we have to hold on to the positives of the simplifications is that you really get the chance to now get really good at what matters for your business when it comes to your impacts. Maybe we can just quickly round off on what this means for companies going into 2026. 2026 is not, I don't think we should see 2026 as just a year two of reporting or a grace period. I think it's really the year where the Omnibus, Stop the Clock directive, and the simplified ESRS are concretely shaping what CSRD will look like in practice. And I think it's important that we keep tracking the moving pieces. The scopes, the thresholds, the timings, the national transpositions are still evolving, and these can still affect wave 1 and 2 companies depending on when it becomes transposed. If there are any last minute turnarounds, whatever happens, I think it's so important that we still track all these pieces before they come together. I think, secondly, refresh or start your double materiality assessment and your strategy. Use the simplified ESRS structure and treat materiality not as a data point checklist, but as a way to really define your sustainability narrative. And of course, this is slightly different for both wave 1 and wave 2 companies. If we go to the next slide, we have a bit for both wave one and wave two companies. Uh, if we could move the slide, please. Yes, there we go. I'll just keep it short here, but for wave one companies, so these are the ones already reporting, the message is quite clear from the European and the EFRAG is to simplify and professionalize. Use your 2025-26 quick fix reliefs, but use them smartly. Nextly, plan your transition in to the revised or simplified ESRS. Decide whether your future target state is the full ESRS. We have heard that some companies still do like a lot of the data points and disclosures that the full ESRS has used. And adjust your reporting architecture accordingly to what you're going to use in the future. Thirdly, really streamline, don't just comply with it. Use your 25 and your 26 reports to cut all the boilerplate. Focus on strategy, focus on your risks, focus on your capital allocation and performance. And finally, tighten governance and assurance readiness. Strengthening internal control over sustainability data will still be essential, not just as assurance expectations rise over time, but as a whole, we're seeing, even if there's a reduction in data points, it's still rising of interest. On the next slide, we cover wave two companies. There, of course, is slightly more uncertainty there, but this is for the ones entering CSRD. The postponement buys time, but doesn't change where you're going to end up. So start with a CSRD or ESRS gap analysis, map where you are today against this simplified ESRSs and the key topics most likely to be material to you. Don't wait, because the second point is use the postponement wisely. You treat 2026 and 2027 as you build your phase for systems, your processes, your documentations, and internal controls. Don't sit around and wait too long, because otherwise you'll have a lot of work to do. And finally, prepare for your value chain pressure. Even with delays and the opt-outs, customers and lenders do, as we see it, will continue requesting sustainability data. So define your approach already now. What will you collect? What will you share? And what will you potentially decline? And I think that just leaves us for the next section quite well, which are then the insights we have, of course, from Merete and Camilla. So I'll hand over the microphone back to you, Anniina, and let you take it from there.
Thank you so much, Julia, for this walkthrough of some of the key changes. And of course, we could also go into even deeper detail into any of the standards in terms of what the changes actually mean. But let's try and stay strategic here in terms of what this means, in terms of what do we now see in terms of key changes and what we actually think will change in the reporting landscape based on this. Merete, I want to start by asking you, because of course Ørsted is known for very structured, ambitious, high quality reporting. What are the changes you see on the horizon now as you see the revised ESRS, and maybe also some learnings from your first year of reporting?
If I start with the learnings from our 24 report. So we of course look back and compared to both the Danish companies and the European companies. And we could see that within the Danish C25 listed companies, we actually had the longest report of 100 pages of sustainability information, where we learned that the average was 70 pages. We also had...
Still a lot with 70 pages.
Yeah, I think still is a lot, but we had a record there, and our management think it was not the record we should aim for going forward. We also had 40 ROs, where the European average was 30. So therefore in 25, we have worked on levers to reduce our report. And the principles we used, of course, we looked into the drafts in July when we came back from summer holiday. That was the legal Christmas present there. And then we listed some levers, and we wanted to avoid duplication and use more concise language, improve the readability, ensure that we use a language with less technical details, and also omit negative statements that we actually put in more as a tick mark exercise. And also some of this more static information you write about approaches and policies, shorten that because it's more interesting to read about how you progress towards your targets with your actions. So we look back, and I think there are good improvements in the new standards where you can actually tailor your report better to what is the decision useful. And then, if I should comment a little bit of the changes, more what I most think are the best improvements. I think first of all, this higher degree of flexibility. Also, Julia mentioned there that actually I see it a little bit like the management review in the annual report. So that is developed through really many decades, and you can tailor the information in the management review to what have been the events of the year, what is the company's strategy, what has been the highlights of the performance. And often the investor relations, etc., they know what are the investors interested in. So you can much more tailor that the first pages of the annual report. And I think with the new ESRS, you can also more tailor the sustainability statements to what the investors and analysts they are interested in, and stakeholders in general, because it's not so strict. You can restructure. You can also put in more summaries in the beginning. You can use an appendix, and so it will be easier to tailor the report to the users' needs. Of course, it requires that you know who your users are, and there are quite many different users. So it will also be difficult to find out exactly who is it that we target.
And of course, this has been one of the pain points that we've also heard a lot of companies be frustrated about, that the rigidity of the first version of the ESRS has really created quite a strict format that challenged also maybe some of the storytelling companies wanted to have. I guess the question then is, what does this mean for the comparability of the information? Will we again see a landscape where there will be a lot of different types of reports, and that it will be more difficult for companies to compare with each other, or for stakeholders to compare companies' performance with each other? Do you have any thoughts, Merete, around how to balance that, what companies want to communicate, and also the comparability side of things?
I think we do still have the auditors, so I think the limited assurance, I'm happy that that's still there, because it will still ensure that you go through the same process, you go through all of the data points, and you need to make an argumentation internally to all of the data points that you filter away, because I think it's positive that they can now also filter away some qualitative information. Before, in the current ESRS, is only quantitative data where you can filter them away if it does not make sense. Now you can also apply that to qualitative information, but you still need to argue, why have you filtered this away? So I think you still need a rigid and robust internal documentation. So I think it will help with, you can just not cherry pick. I hope still that I'm so sure that the auditors, they will still require that you have that documentation in place, so that you still include all of the disclosures that are relevant to your company. So I'm not so worried. I think the key information companies, they still also want to be able to fit into different other ratings, etc. So you need to inform balanced and correct still.
And I think actually now we're kind of going into the landscape where you, Camilla, are working every day. You are, of course, a stakeholder in this game. As a bank, you look at the data companies put out there, and you also put requirements on your clients. You help them as well, of course. Can you maybe give a few words around what have you been most focused on in 2025 when it came to the sustainability data, and also what do you see when you look into 2026? because of course you are also setting the agenda here in terms of representing a large bank. Go ahead.
Yes, thank you, Anniina, and thanks for having me. I think so what we do, or what I do in my team, is that we wear two hats. So we do advisory of clients on sustainable finance. So we structure sustainability-linked loans, sustainable bonds, and so on. So that's one hat, and general ESG advisory as well. And then we have the other hat, which is, the banks need to mitigate the ESG risks of the clients as well, because the client's ESG risk is our ESG risk. And I think what has gone a bit under the radar this year, due to the focus on CSRD and Omnibus and all this, is that the banks are actually now required by law to integrate ESG risks in the credit assessment. So this means that material ESG risk for the companies needs to be included in the credit assessment on the same level as, for example, client concentration, financial metrics, credit metrics, and so on. So this is way below, the threshold here is way below 1,000 employees. So for Nykredit, we're required to integrate and assess ESG risks on all corporate companies that has 20 million or more in loans with Nykredit. And that's not much. So I think what we're seeing, we've had a year now of communicating and starting to implement, the regulation. We've been working with integrating ESG data in credit for some years, but it's way more structured now due to the regulation. And we've actually already, both us, Danske Bank, and Jyske Bank has been inspected by the FSA on this. So it's really on top of mind from the regulators as well. So this means that the banks, your lenders, the ones providing capital, will keep asking for ESG data. And I think this is my most important message here today, is that even though you're exempt now from the ESRS, from the CSRD, and below 1,000 employees, then you're exempt. But that doesn't mean that your most important financial stakeholders will keep asking for this data.
So there's still that pressure there to keep providing that type of data.
Yes, for sure. And I think when we're talking to customers about this, both the biggest clients that we have, but also the smaller ones, everyone is first of all, they're a bit surprised about that it's actually required by law. But they also appreciate that we're clear about what kind of data is it then that we want, we ask for. So I think that will be the focus also for 2026, is that we need to build this data book, basically ESG data book on all our clients, so we can see what is the actual impacts and what is the emissions of our balance sheet and so on.
And I can already see that the chat is here, or the Q&A section is blowing up here now. So one of the questions we're getting here, Camilla, if this bank requirement, is it an EU level requirement, or is this a Danish requirement?
So it's an EU level requirement, but it's implemented by the local law. So just like CSRD and everything else. So how it works in the other countries, I can't comment on, and I'm not an expert on how exactly it works in Denmark as well. I'm just on the floor, working with it and integrating it and communicating this to clients. But this is something that is EU wide.
So I guess the key message there is that the pressure is still on to deliver data also from different angles, and the ESRS is one important piece of the puzzle, but it's not the only piece of the puzzle. I'm curious, Merete, as you are also working with not only the report, but also thinking about how to strategically work with ESG data, how much in your planning internally do you think about what different, like the sequencing of what data you improve? How much is it about the legislative requirements, and how much is it about what stakeholders require?
I think our starting point is the double materiality assessment, because it's also what our management, they say we start with materiality, because then we will ensure that we have the majority correct. So we will start there. So I think we will still, of course, start with the double materiality assessment. And Camilla, as you also say, and we hear from others, there are much more asked for, also human rights benchmarks, etc. There's so many rating agencies that are requesting a lot of other information, but we will still start with the double materiality assessment because we also have limited resources. All of the companies, we also need to be efficient and ensure that the data that we have, they are of very high quality. So I think it makes so much sense to start there. And also, again, that is the regulation from the EU. From the beginning, the whole thought was to strengthen the data that is in scope, so the 10 topics, for instance. So we'll start there, and ensure that we improve all of the data. We have very good systems for the quantitative data, but of course, qualitative data you can always be better at documenting, and they are a bit harder to put into a system. But we will focus on what is within the. Of course, we also reply to rating agencies, not to say that, but you also need to prioritize, and there are many, many, many stakeholders to satisfy.
Exactly. And you, of course, now mentioned the DMA. And I wanted to actually ask, and that's a question I can also see here, we're getting in terms of the DMA and the way of working with your materiality assessment. Merete, you, of course, invested already quite a lot into the materiality assessment you have. Now you actually get also some ways of doing it in a new way with these new standards. How well are you already aligned with that? And do you think there are some kind of changes coming now also in terms of how you approach your DMA?
Yeah, I think we actually fully support that the starting point from the DMA now in the standards is how the business operates, including which effective measures you already have in place in your day-to-day operations. We did our first DMA in 23, and that was our own starting point. That we say, of course, you should take into account your day-to-day operations. How do you prevent and mitigate safety incidents, for instance, and good business conduct, all of that. So we have taken that approach from the very beginning. So the new SS will actually not have big implications because we have tailored our methodology, and our process is actually more or less aligned. We will only fine-tune a little bit. And I think that makes also a lot of sense. Also, that you can now apply more common sense, because we have been struggling, for instance, with this health and safety. In a company like ours, we have really that's one of our key KPIs. We have so much prevention, mitigating actions working day to day, and then you can actually risk that you don't put up these actions and targets if you should go very true to the regulation. But now you can put it in still, and you say, we don't have a lot of incidents, we don't have fatalities, etc. But of course, investors are always interested in health and safety in an inherently dangerous industry. They are interested in money laundering in banks, etc. So of course, you should always put that common sense on top of your DMA. So if investors are interested in specific topics for your sector, they should be able to find your policies, actions, targets, and what are your well-functioning preventive actions already in place. So I think that makes much sense.
Julia, I can also see there's a question here on the DMA simplifications that I think you might be the right person to tackle. The question is, can we have some more examples of simplification? What are the main simplifications that the DMA now allows for? Can you maybe elaborate a little bit on that?
Yeah, so it's just looking at this question, but I think how best to explain it is that the DMA has become more intuitive. Materiality applies at the topic level, not the data point by data point level. Your assessment should really focus more on judgment and documentation, not this exhaustive evidence trail you had to leave before. For example, there's also reduced references to significant versus non-significant impacts. So in general, it's more focusing your reporting and the outcome of the DMA on the bigger issues. It's also a lot in the presentation in the ESRS of how the DMA needs to be conducted. It's in the language has been simplified around it. I think the biggest thing is also that you don't need to go into the 3 characteristics of severity either. You don't, for each topic you identify or for each impact, risk, or opportunity you identify, you won't have to go into scale, scope, and irremediable character in depth if you believe that topic is material. Of course, we believe that doing this can still provide you with quite a lot of relevant information and how you then manage this, but I think there is a lot of interesting updates in general and simplifications around how you approach it. It's more company specific now than providing you a template that you have to follow.
Mm-hmm. And would you, Camilla, say, as you're looking now into this field from again your point of view, how much are you looking into the DMAs? Is maybe one question from a bank's point of view, and then maybe second question, what are the things, if you would now give advice to the companies listening also to this webinar, what type of data would you really sharpen up going into 2026? What do you think the banks are most interested in when it comes to next year?
Yeah, I think that's a great question. I think, in collecting our ESG data and figuring out what are the ESG risks for our loan book, of course, it also depends on the DMA for the clients, right? But I think for now, this is a learning curve for the banks as well. I just want to emphasize that. This is not the banks being perfect on this at all yet. How we work with it in Nykredit as of now is that we've started with granular data on climate, which makes sense because this is where we have the most data. This is where most companies has been focusing for some years. So climate data, scope 1, 2, 3 data is important. And then another one that's quite important for us and banks in general is that you have transition plans in place. You can describe how are you going to reach these targets that you have in your transition plan, because the banks also have to transition, right? So we have, for example, have SBTi validated targets, and 98% of our emission comes from our loan book. So if our clients don't transition into low carbon, then we're not going to reach our targets either. So I would say we collect data broadly on ES and G, but definitely the focus, if you were to start somewhere and you haven't started reported yet, you're a smaller company, then I would definitely start with getting your greenhouse gas emissions collected, provide the data, and then from there you can start making these transition plans, which will be required from lenders going forward. I think one more important point to just not to make everyone feel bad almost is that we since the CSRD we map the data requirements that we have to the ESRS. So we've mapped the current data requirements that we have to the former ESRS before they were simplified, and I am fairly certain that we will map our data requirements to the new ESRS as well. And then finally, in terms of a good advice here is that even though that you're a small company or you're not in scope for CSRD, keep reporting on what most material to you. So use the VSME standard if you're a small company, or use the voluntary ESRS if you're a medium company that's not required by law, because your stakeholders still need this data.
Thank you so much, Camilla. And I can really see here in the chat section of the Q&A that I'm looking at, we have a lot of questions. It sounds like we might have to have you back for a separate webinar where we dig even deeper into the bank's expectations. Thank you so much for being here today, Camilla. We are a few minutes over time, but I do want to ask you, Merete, the final question, because of course, you're not as such expected to start implementing these changes right away. There will be a grace period here. But are you already in 2026 going to start taking in some of these changes if that's made possible?
Now you're speaking into the 26 annual report, yes. I assume? Yeah, I think there's a long time to wait until the 27 report, actually. Yeah, of course, we will look into it, because especially the parts where we think it makes a lot of good sense. And then it could also be nice if it was allowed to pre-implement by the regulators. Maybe that's too much to hope for, but that would actually also make the assurance process more smooth. Because if we want to take more of this into consideration with make the report more reader-friendly, tailor it more to the stakeholders, it will be a little bit too long to wait until 27, because if we cannot really wait with the parts where we think it makes a lot of sense. So I will cross my fingers for that we can pre-implement in 26, and then I think a lot of companies will lean into that in the 26 report.
I guess already we can see that the Commission is at least thinking about it from some of the statements that we've seen in the past weeks for those companies who want to start taking in the changes into their 2026 report, that they're trying to make that possible. But I guess some of the details in terms of what that looks like remains to be seen once we see the full completed process here. We are at 9:50, which is where we will round off this webinar here today. We will, of course, continue from Nordic Sustainability side to follow this closely. We're continuously publishing different knowledge pieces, articles where we dig even deeper into some of the changes. And I can already spoil that, of course, we will be going through in detail as well into the revised ESRSs here, so that you get a really good, thorough go through of what's actually changing. We're also posting every time there's some new guidance coming up. And of course, we'll keep hosting webinars like this to share knowledge as well. I really want to say a big thank you, Merete and Camilla, to both of you for participating this morning and enriching the conversation. Julia, thank you so much for the technical go-through. Thank you, everyone listening in. It was lovely to have you. Thank you for your great questions. And upwards and onwards in sustainability reporting. It's never a boring day, and I'm sure 2026 has more in share for us as well. Thank you so much, everyone. We round off this webinar here today. Thank you. Goodbye.